Stop looking at the red candles on your screen. Stop obsessing over the ticker tape that tells you the price of silver has collapsed. That price is a lie designed to extract your wealth. It is a digital hallucination. Look instead at the number 30 million. That is the only number that matters in the global financial system right now. It is the number of ounces left in the registered vaults of the COMEX. It is the number that signals the mathematical end of the paper market. While the financial press is busy analyzing a market correction, we are staring at a structural fracture in the architecture of global trade. We are witnessing the great divorce between paper derivatives and physical reality, and the papers are currently filing for bankruptcy. If you are looking at the spot price, you are looking at a ghost. If you are looking at the vault data, you are looking at a crime scene. The events of the last 96 hours represent a synchronized, multidimensional collapse of the legacy financial mechanisms. You saw silver plunge from near $120 to under $80 in a single trading session. The mainstream media calls this a bubble bursting. They compare it to the Hunt brothers in 1980. They are lying to you, or they are too incompetent to read a balance sheet. This was not a market correction. This was a liquidation event engineered by the exchange itself. The data from the CME group is unequivocal. On Friday, they raised maintenance margins by 30%. They increased the capital requirement from $25,000 to $32,500 per contract. This is a classic margin trap. Think about what that means for the market structure. Thousands of speculative long positions held by retail traders and hedge funds were suddenly underwater. These entities did not sell because they believed silver was worth less. They sold because the exchange held a gun to their heads and demanded more capital than they possessed. It was a forced liquidation designed to protect the clearinghouses from a cascade of defaults. The exchange changed the rules of engagement in the middle of the war to save the short sellers. From an insider perspective, this crash is the most bullish signal imaginable. It has flushed out the weak hands, the paper speculators, while the strong hands, the physical buyers in Shanghai and Mumbai, have not flinched. They are standing there with their buckets, catching the falling knives and thanking the West for the discount. But the price action is merely the smoke. The fire is burning in the logistics logs, and the data regarding the physical inventory coverage is the most terrifying statistic in the history of the metals market. The registered inventory at the COMEX has plummeted to approximately 30 million ounces. You must understand the difference between eligible and registered. Eligible silver is metal that is sitting in the vault but is owned by private parties and is not for sale. It might as well be on the moon. Registered silver is the only metal that is actually available to settle the thousands of paper contracts being traded. With open interest representing hundreds of millions of ounces of paper claims, the amount of physical metal actually supporting those contracts is now less than 14%. Do the math. For every 7 people holding a contract that promises them silver, there is only 1 bar of metal in the vault. This is a game of musical chairs played on a global scale, and the music has already stopped. The exchange is praying that you do not ask for your metal. They are praying you will settle for cash. Because if just 1 out of every 5 contract holders stands for delivery this month, the COMEX will default. It is a mathematical certainty. You might be asking yourself why the inventory is draining so fast if the price is dropping. This is the paradox that confuses the amateur. In a normal market, low prices discourage selling. But this is not a normal market. This is a market being drained by an arbitrage vacuum of historic proportions. While the paper price in New York was smashed down to $70 or $80, the Shanghai Gold Exchange has been trading physical silver at a premium of nearly $20 over the spot price. This price gap is a massive pump, sucking every available 1,000-ounce bar out of the Western vaults. The metal is leaving New York. It is leaving London. It is flowing east, and it is never coming back. We are seeing the weaponization of the supply chain by the sovereign powers of the East and the South. This brings us to the supply shock that the algorithms have completely ignored. The market has operated for decades on the assumption of infinite elasticity. The bankers believe that if the price rises, the miners will simply dig more holes. That assumption died in January of the year 2026. The 3 largest silver producers in the world are Mexico, China, and Peru. They have effectively formed a cartel, not by signing a treaty, but by simultaneous acts of resource nationalism and operational failure. Look at Mexico. They are the Saudi Arabia of silver. For centuries, their mines have fed the global vaults, but the new administration, following the resource nationalist policies of the previous era, has invoked Article 27 of the Constitution. This article establishes that all minerals are the property of the state. Intelligence indicates that under the guise of strategic sovereignty, Mexico has halted foreign silver shipments. They are drafting a 20% export tax on primary silver. But the functional result is a total freeze. Approximately 6,000 tons of annual production are now trapped within Mexican borders. The primary miners, companies like Fresnillo, cannot absorb a 20% gross revenue hit. They are stockpiling inventory instead of selling it into the global market. They are waiting for the tax to be lifted or for the price to rise enough to cover the cost. This mirrors the oil embargo of the 1970s. The supply chain is not just broken, it has been turned off. Then you have China. Beijing has implemented a rigid export control regime that went into effect on the 1st of January. They have designated a list of merely 44 companies allowed to export silver. This move eliminates hundreds of smaller refiners and traders who used to provide liquidity to the London Bullion Market Association. The strategic intent is crystal clear. By restricting exports to state-affiliated entities, China is retaining silver for its own massive industrial and solar energy consumption. They are weaponizing the supply chain to force Western technology companies to pay a premium or relocate their production to China to access the metal. And finally, there is Peru. While Mexico and China use lawfare, Peru is drowning in chaos. Ongoing strikes and social unrest have paralyzed the mining corridors. The cumulative effect of the instability from the previous year has left the supply pipeline completely dry. The intelligence reports confirm that Peru has locked its doors through sheer operational incompetence and civil disorder. So you have the three biggest suppliers offline, while the COMEX vaults are running on fumes. This brings us back to the mechanism of the collapse we witnessed on Friday. The crash was a liquidity event orchestrated by the CME Group. When they hiked the margins, they knew exactly what would happen. They knew the algorithms would sense the margin cascade and pull their buy orders. They created a vacuum underneath the price. This allowed the bullion banks, who are perpetually short, to cover their positions at lower prices. They used the volatility to wipe out the leverage. But they cannot print silver. They can print contracts, they can print dollars, they can print margin calls, but they cannot print a 1,000-ounce bar of silver. The disconnect between the paper price and the physical reality has reached its kinetic limit. We are in the eye of a volatility hurricane. The drop in open interest is being hailed as a sign of stabilization. It is not. It is the calm before the default. The inventory levels at the COMEX are critical. When the registered stocks fall below a certain threshold, the confidence in the contract evaporates. We are approaching that threshold at terminal velocity. The implications for you are binary. You either own the metal or you own a claim on the metal that will be settled in devalued currency. When the COMEX declares force majeure, they will not give you silver. They will cite the rulebook. They will give you cash. They will give you dollars that are being inflated away by the very central banks that are currently buying gold and silver hand over fist. You will be made whole in nominal terms, but you will be destitute in real terms. The Shanghai Premium is the smoke signal. It tells us that the physical market has decoupled from the paper market. The East is paying the real price. The West is trading a fantasy price. Eventually, the arbitrage will drain the West dry. The vault in New York will be empty. And on that day, the price of silver will not be set by a computer in Chicago. It will be set by the physical possession of the metal. You must stop thinking of this as a trade. This is not a trade. This is an exit strategy from a failing system. The system is trying to shake you out. They hike the margins to force you to sell. They smash the price to make you panic. They want your silver. They want you to hold paper while they accumulate the hard assets. The central banks are buying. The sovereign wealth funds are buying. The Chinese state companies are buying. Who is selling? Only the leveraged speculators who have been trapped by the margin hike. The narrative of the dollar strength due to the new Fed nominee is a head fake. The market thinks Kevin Warsh means a stronger dollar and weaker gold. This is a misunderstanding of the year 2026. The debt load of the United States makes positive real interest rates mathematically impossible. They cannot crush inflation without bankrupting the Treasury. The only path forward is financial repression. They must keep rates below inflation to inflate away the debt. The recent rally in the dollar is a temporary cover for the bullion banks to reload their shorts. It is a gift. But that gift is expiring. The physical shortage is the ultimate arbiter. You cannot fake inventory forever. When the factories in global tech hubs stop receiving shipments because Mexico is closed and China is hoarding, the panic will move from the financial exchanges to the boardrooms. We are already seeing the early signs of this supply chain paralysis. The copper mines in Chile are striking. The Red Sea is closed. The logistics of the world are fracturing. Silver is just the first domino because it is such a small, tight market. It is the canary in the coal mine, and the canary has stopped singing. The drop to $80 is irrelevant. The only relevant data point is the coverage ratio, 14%. That is the probability of the system functioning as advertised. 86% is the probability of failure. Those are not odds you should accept with your life savings. The frantic nature of the margin hikes suggests that the exchange knows how close they are to the edge. They are trying to deleverage the system before it breaks, but they are too late. The physical metal has already left the building. The divergence between the paper price and the physical reality is unsustainable. Physics always wins. Economics always wins. The paper market can distort reality for a long time, but it cannot change the laws of supply and demand forever. When the registered inventory hits zero, the price becomes infinite in paper terms. We are watching a slow-motion bank run on the bullion banks. The people standing in line are not retail investors, they are sovereign nations. You need to understand the gravity of the singular moment we are in. The singularity is not just about technology, it is about the collapse of the debt-based pricing model. The great divorce is final. The papers have been signed, the assets are being split. The East gets the gold and silver, the West gets the debt and the derivatives. Which side of the settlement do you want to be on? Do not let the volatility shake you out. The volatility is the weapon. The margin hike is the weapon. They are using every tool in the box to pry the metal from your hands. They need your silver to cover their shorts. Do not give it to them. The premiums in Shanghai prove that the metal is worth far more than the screen says. The market is screaming at you, but it is screaming in a language that the news anchors do not speak. It is the language of backwardation and physical premiums. The era of cheap silver is over. The era of available silver is ending. We are entering the era of unobtainium. The window to convert your paper wealth into physical ounces is closing. It is closing not because of price, but because of availability. Soon you will have the money, but there will be no metal to buy. The mines are locked. The vaults are draining. The ships are diverting. Do not be the person holding a contract when the music stops. Be the person holding the bar. The system is blinking red. The inventory data is flashing a warning that has not been seen in our lifetime. 30 million ounces. That is all that stands between the current order and total chaos. That amount is consumed by the solar industry in a matter of weeks. It is a rounding error in the global economy. Yet it is the linchpin of the COMEX. When that number hits zero, the game is over. The illusion of infinite liquidity will shatter. The price discovery mechanism will shift from the futures market to the physical market. And the price will not be $80. It will be whatever the holder of the metal demands. Stop watching the news, start counting the ounces. Check your personal inventory. If the number of ounces you physically possess is zero, then you are a volunteer victim of the coming default. You are trusting a system that has just told you mathematically that it cannot pay you. Do not hide from this reality. If your number is zero, admit it. Write the number zero in the comments below this video. Acknowledge your vulnerability. That is the first step to survival. If you have a stack, write the weight. Prove that you are part of the remnant that understands the difference between a promise and a possession. The vault is emptying. The clock is ticking. What is your number?